بسم الله والحمد لله والصلاة والسلام على رسول الله. اللهم علمنا ما ينفعنا وانفعنا بما علمتنا وزدنا علما. Hello everyone, this is Liquidity Club by Ahmed Shawi. Today I'll be doing a trade breakdown, Friday's trade breakdown, which is the 25th of October 2024. I'll be addressing some things that I'm looking at when looking at the charts at specific times of the day. So this is primarily done just to pretty much remind myself of the things that I'm doing right now, and it could be um, a motivation or something that can be taught or to guide my children or anyone who's trying to pretty much learn how to read these markets. So let's get started. I'm starting from top down, from the weekly time frame chart all the way down to the 1 minute time frame chart. I'll try to explain everything from top down fashion, if you'd say. So starting with the weekly time frame chart, as you can see, price has just been keep pressing up higher, and we've been expecting price to retrace into internal range liquidity. Now, what's internal range liquidity? I'll try to simplify every single terminology or term that I say during this presentation or this educational video. So internal range liquidity is considered the favor gap or inefficiencies that is found below the buy side liquidity and above the sell side liquidity. So it is in this form, as in this case it's the busy buy side imbalance, sell side inefficiency. So it's inefficient with the sell side delivery to the downside. Anyway, we've seen price trading down lower and filling this inefficiency. So from the weekly time frame chart, we're getting the direction that we're likely going to see some lower prices. So when we go down lower into lower time frame chart, we'll have a directional bias into our mind that we are looking for lower prices pretty much. So going to the daily time frame chart, this is just to magnify anything about the weekly time frame chart. If the weekly time frame chart is not pretty much obvious to you, you can drop down to the daily time frame chart and you can follow the same protocol. You're just seeing where price has traded to, where it has came from, and where it's likely to reach to. So if price, as in this case, it has been pushing up higher to the upside. So we're coming from lower prices, as I mentioned, and we're pushing to the upside. Now, as in this case, we're pretty much fulfilling buy side liquidity orders that are resting above the marketplace. And as a result, we have sell side liquidity that is being built down there. And also the internal range liquidity that is being built inside the market, inside and below the buy side liquidity and above the sell side liquidity. So we've seen price trade. It's Monday, Tuesday, Wednesday. We traded down into the pivot gap, and then Thursday, sorry, we have an inside day where the high is lower than previous day's high, uh, and the low is higher than previous week's low. So going to Friday, we're expecting some kind of a movement to take out one of both sides. It can be the high or the low. We do look for some things in the market that can tip its hand to us. It's like a fingerprint or footprint that we can follow in order to get some insight, some intel that we can use to trade these markets. So let's drop down to the 15 minutes time frame chart, and just want to let you know this is my, as my mentor has said, it's the bellwether chart. It's where everything is shown to you. You don't need to go for the 4 hour time frame chart, 2 hour time frame chart, or even the hourly time frame chart. You can just drop weekly, daily, and to the 15-minute time frame chart. You don't need to go to the hourly chart or 2 hours or 4 hours or 12 hours. You don't need any of that. You have the 15-minute time frame chart, it will do more than enough to you. Like, you don't need anything else other than a 15-minute time frame chart. And if it's just the single time frame that I'm going to be looking at, is going to be the 15-minute time frame chart. So there's a few things that I want to explain about some of the things that are showing here on the chart. First things first, we have identified buy side liquidity pools that are present, they're pretty much there when we opened here on Fridays, where we opened here at 9:30. So we have Wednesday's high, as you can see right there, and we have also Thursday's high. I didn't bring your attention towards it, but we have a high here, which is Thursday's high. So we have two liquidity pools right there. And also we have the opening range gap price. We have price closed previous day on Thursday at 4:14 p.m. New York time. All of the things that I've mentioned in terms of the time, it is referred to as in New York time. So at New York time at 4:14 p.m., or it's also the 16:14 p.m., wherever price has closed, we take this level, we take this it, and we just extend it in the future. Because on the next day's opening, it's gonna be a crucial element for us to be looking at, and as well as the opening range gap high, which is the opening of the same day that we're trading at. So we're trading on Friday, that's the day that we traded. So we mark 9:30 opening price, and we mark previous days, which is Thursday's closing price at 4:14 p.m. That's 4:14 p.m. That's when the US market closes. All right. Although there's been some extension now, and I'll be covering about that in the future videos, but for now, this trade has been done before they did any announcement about their extending the trading hours beyond 4 p.m. But as of now, as of what I'm saying here about this trade, market has closed at 4:14 p.m. So we extend this in the future. Now we have a low, which is this price level, opening range gap low, opening range gap high. In the midpoint of these two levels is considered the consequent encroachment, which is the midpoint. So if you take your Fibonacci, or you can just measure it, you see that low to that high, you see that the midpoint is the constant encroachment. Now, this is just an information for to you. Um, most of the time, so most times than not, when price opens at 9:30 a.m. New York time, it has a more chance or more probability than not to retrade back towards the consequent encroachment of the opening range gap. This is a really, really important thing that I've just mentioned. You need to write that down. There is a high probability that price is going to retrace and trade back into the consequent encroachment of that opening range gap. So how do you use this information? I mean, like, we opened here and we just kept pushing up higher. How would you know that price is going to stop here and just start rolling down lower and reach for lower prices? Here's the missing element that many of you, like, you're not still aware of it. Price when opens in premium, as I've mentioned, we closed here and we opened in premium. That's opening in premium. That's a gap. We opened in premium. When opening in premium, we never try to look for shorts immediately. We want to see price trade up higher, even further than what it has reached to. I mean, it already has gapped about 10, well, 20 handles, I should say, or 18 handles. But that's not enough for us to just go short just for that. We need to look for evidence that the market is tipping its hand, that it wants to run down lower. One of the things that you have to look for if is that if we open in premium, is as in this case, we open in premium, we want to see price reached into a buy side liquidity or to fill an inefficiency before trading down lower. So you cannot look for shorts immediately before we trade into a significant liquidity pool, or we fill an inefficiency. And inefficiencies can be a favor gap, volume imbalance, etc. So we need to do one of two things before you can start looking for lower prices that can reach into the consequent encroachment of the opening range gap. So I know it could be a lot of information for you to absorb or to pretty much process, but I'll try to make it simple to you. We mark down the closing price at 4:14 p.m. New York time. We extend it in the future, and this is primarily just for futures trading or the indices, the US 500 or the S&P 500 NQ, Nasdaq, and Dow, which is YM. So these are primarily just for the indices or the futures trading. So you mark down the closing price at 4:14 p.m. You extend it in the future, and we mark down the 9:30 opening price, and we extend it in the future. We mark both of these levels, and we look for the midpoint between these two levels. You can use the Fibonacci as what I'm doing. I just use the Fibonacci and I pull it, look the midpoint, mark it down. That's it. So once I have this level, and if you're writing your levels on a notepad as I'm doing, you can write it down, and there's a high probability that price is going to retrace and trade back into that level. But before doing so, we need, since we open in premium, so always when we're opening a premium, we need to see price trading into a buy side liquidity or to fill in an inefficiency. And whatever I'm mentioning here in this educational video, it can be diametrically opposed for sell side, for pretty much vice versa. So if it's like flipped, if we open in a discount, we want to see price takes out a significant sell side liquidity or fill an inefficiency before running up higher, reaching to an opening range gap low, encroachment, or the high. That's if we're vice versa, diametrically opposed to the higher prices. But as of in this case scenario, we have run it up higher, opened in premium as I've mentioned, and we pushed up higher to take out Wednesday's high right there. It's the buy side liquidity. It's a significant buy side liquidity, which is because it's a daily high. It's not a session high. No, it's a daily high. It's a whole day high. This is Monday. This is Wednesday trading, and the highest high is right there. And we took it out here on Friday. After we took this buy side liquidity, we started looking for the next strong liquidity. The algorithm will immediately just flush these orders in, spool orders just to drive towards the consequent encouragement of the opening range gap. So trading down lower, that's the opening range gap. Below the opening range gap, we have London session sell side liquidity right there. Now below London session sell side liquidity, what do we have? If price would have a runner, we have the weekly fair value gap that I've mentioned or draw your attention towards on the weekly time frame chart. So if people have missed or skipped looking at the weekly time frame chart, this movement right there, it would have just gone over their head because they're not aware of why the market is reaching towards this level. But for us, as I'm trying here to break down this trade, I'm trying to keep you informed of why the market is just pretty much extending below the sell side liquidity and how far can it extend to, where can it reach to, because we cannot refer just to sell side liquidity. Oh, there's a sell side liquidity price is reaching towards right there. That's it. That's just like the tip of the iceberg. You have to be informed about everything around you in these markets. So going pretty much, I wanna get break it down to the pretty much to the 1 minute time frame chart. I'll try to do that. Dropping down to the 5 minute time frame chart. Now here's one thing I'll try to draw your attention towards. I want you to just pretty much remember how we have a high here and a higher high. So price formed a high at roughly about 10 a.m. and then about 10:25, 10:20, we formed a higher high, as you can see, a higher high. And then we started running down lower. At these times here, at these area, I'm looking for confirmation. I'm looking for a signature that can tip its hand to me that we are now switching the program and we're like starting the sell program, the session sell program. We're not saying a sell program for the outlook on the daily and weekly time frame chart. No, I'm mentioning sell program for this session. So as I mentioned, just keep your attention towards this high, higher high at 10 a.m. and about 10:20, 10:25 we have higher high. If we check out Dow at 10 a.m., we have formed a high, and 10, 25, 10, 20, we have formed a lower high. This is what is deemed as SMT. Now, my mentor hasn't pretty much coined it in a term, what SMT is abbreviated to, but we just call it SMT. It can be smart money tool, it can be whatever you want to call it, all right? But it's called SMT. It's where like you're doing. It's pretty much, just to put it in a simple terms, you're just doing intermarket analysis between two closely correlated markets, where one market could be tipping its hand where it's showing higher highs, or yes, as I've mentioned here on ES, higher highs, but one of these closely correlated markets decided to and refused to take out this high. This showed that this is weaker to the downside. That's great. Once we have this signature, once we have this confirmation, and we have everything behind us, the things that I've been mentioning since the beginning of the video about the weekly, daily, 15-minute time frame chart, everything that I've mentioned about the opening range gap below us, how we took out right there, how we took out Wednesday's high right there. So everything is behind us to pretty much. So the SMT by itself is nothing. The SMT by itself is pretty much useless. You have to put it behind something that weighs matter, that weighs a lot. And the things that I've been mentioning, these are the things that I'm looking at. So if SMT wouldn't be there, it's not that I'm not gonna be taking the trade. SMT is just like a confirmation, something additional that I'm looking at. It's just something that pretty much as a confirmation signature that is found in the price action or the markets. It's not always there, but many times than not, you'll see it in the markets. And it's like tipping its hand that now I'm switching programs and I'll start the sell program, or vice versa, I'm starting the buy program. So, and you always want to go with the, if you're looking for shorts, you would want to go with the weakest pair. If you want to go longs, go with the strongest pair. The pairs, I'll try to explain it. If you're going long, you want to go with a pair that refuses to make lower lows. All right, this will create mitigation block in the pair that you're trading, which is stronger to the upside. Mitigation block is better for you for just price is going to be just pushing up higher, and vice versa. When you're looking for shorts, you want to trade the weaker pair, which is the pair that refused to make a higher high. Now you'd ask me a question, but why didn't you trade Dow? Because Dow has pretty much obviously created a lower high. So in my case scenario, Dow is not my, it's not my thing. It's not the thing that I want to trade. So just hold on a minute. I'm gonna be explaining why I chose ES or US 500. Since I'm not in the US, I cannot trade the futures. I'm not trading the futures. I'm trading the CFDs, the indices. So it's not that I chose S&P for nothing. It's like without any protocol why I chose it, because I trade primarily ES and NQ. So just I draw your attention towards how we have an SMT here between Dow and ES. Now going to the actually deeper stuff here, going to and pretty much comparing ES, the S&P 500 and NQ. I know this doesn't say NQ, but you can go, if you don't believe me, you can go to your chart, and you should not believe me. You should take whatever I say here as a challenge and go to your charts and try to prove me wrong, because I'm telling you these things that I've been discussing and I'm discussing right now. These things are pretty much confirmed in the markets. Once you go back and you look through the history of price action, you'll see that they have been always there since the beginning of price action, since the day we started trading. And you can go before the 20s, you can go to the 1900s, and you see how the market is trading the same thing. So it's not something that's new. No, it's just something that is hidden in plain sight, and people cannot see it because they're not well taught to look at these things. They're just studying from retail books that teaches them how to look and spot animal patterns or retail patterns like wedges, triangles, etc., etc., etc. So this is not the point of what I'm trying to teach you. I'm trying to teach you the things that doesn't need to be subjective. It's really objective. It's not something that two people can argue about. It's like, just like, seriously now, we took out this, but this high right there. Is it like subjected to everyone? No, everyone on planet Earth looking at this chart, wherever he is or wherever they are, they will see that Wednesday's high have been swept right there. So it's not something that is people can argue about. Oh, Wednesday's high. Did Wednesday high? For me, it has been swept. Maybe for you, it's not. No, it has been swept for everyone on planet Earth. Everyone who's like viewing the charts, they have been like Wednesday's high have been swept. So it's not something that, and like people can argue about. It's something that is fixed, static in the price actions. It's fixed and static in the markets. You cannot argue about that. All right. So let's get back. So that's the S&P, the US 500, and that's the NQ, Nasdaq. As you can see, everything here is just normal. But when I'm looking to enter here, you can notice how we formed a high, a lower high, whereas on NQ, a high and a higher high. This shows that NQ is pretty much stronger to the upside, and not stronger, but refusing to go lower, just based on this symbol thing that I'm looking at. All right. And then from there, once I've confirmed that we have created an SMT right there, price has traded down lower. Right there, we have formed this as a bearish order block, and we have favorite gap. This is a high probability bearish order block. I traded that and then pushed down lower to the opening range gap right there. So let's go down to the 1 minute time frame chart. This is pretty much since we've opened here at 9:30 and to the part of price action that I'm interested in, to where we have traded into London sessions inside liquidity, and below it the weekly fair value gap right there. So since I've talked about this, let's get deep into the 1 minute time frame chart, and I'll try to explain the things here on pretty much. I'll zoom in here on this price action, this piece of price action, to pretty much discuss it on deeper level. So going to the zoom out version, let's say, as you can see here, when we've traded up higher at 10 a.m., we raided Wednesday's high. Now, this is just an information for you. Whenever we have a buy side liquidity or sell side liquidity or even a fair value gap, any significant PD array, all right? And in this case, it's a Wednesday's high. The highs and lows are PD arrays. And in this case, because it's a daily high, the Wednesday's high, it is even more significant, all right? So we traded up higher the first time to take out the stops that are residing below above the buy side liquidity, and we've seen price just pushing down lower, as you can see right there, and having it one more time running up higher. It's always having this pattern, this signature, this fingerprint, this footprint. It's always there. You just mark down the BD arrays. Many times you'll see price trading up higher into the BD array, retracing a little bit, just tricking everyone that we're starting to push down lower, and then running up high one more time, taking out the buy stops right there, and now the actual run will start. All right. So right there, when we have formed this high and we push down lower below this low, right there, many retail traders and even maybe the people who are informed have went short, and their stop loss very tight. All right, thinking that they have caught the top and they're just now shorting. All right, so they will set their stop loss order above this high or above these highs, trusting it as a safe stop loss order to be kept at this place. All right, and sooner or later, shortly after, price has rallied up higher, took out all of their buy stops. And now here's the interesting part, all right? Once price does that, it has rallied up higher. A lot of them will just look at this as, oh, this is a bullish breaker. The ICT has already talked about this. This is the unicorn. Look at this fair value gap with the bullish breaker. That's it. I'm trading this. They will pretty much risk everything they have, setting stop loss below these two lows, even this, or either this low or this low, and they will just hope that it will start running up higher. Price just consolidate here a little bit. Just look at this as like smart money reversal, and it start breaking down lower. Right there, we took out the lows, the sell side liquidity that's residing below these lows. Now both parties are out of this, or are out of the market. We have swept the buy side liquidity and the sell side liquidity, so there is no one in the market. All this time, people who are like going, like people who went long, some of them they don't have stop loss order below this low, but price has give them some chance here to close their orders manually on a loss or break even. That's why it's called a breaker. All right, so we formed the bearish breaker right there, and then price just kept pushing lower into reaching to low prices. Now I wanted to draw your attention towards something. What do you see here? Right there. What do you see exactly? I'll give you a moment just to think about it. Pause the video for your own benefit. Pause the video and look into it and tell me what you see. I'm waiting. All right, now I know that some of you didn't pause the video, but regardless, I don't really care if you develop as a trader or not. It's not my concern. So I don't really care if you really develop or learn something from this video or not. It's like at the end of the day, it's just your loss. All right. I'm not gonna be saying, oh, please watch, or please pause the video and please learn. I don't give a shit. All right. It's up to you. You wanna learn? Be my guest. You don't want, you can get the fuck out of here. All right. So excuse my language, but you gotta do what you gotta do. All right. As you can see here, we have relative equal lows that were forming going into lunch. So price didn't, when we pushed down lower here, reaching and approaching this opening range gap, we didn't reach into the opening range gap. We've just consolidating just above it. What does that mean? We're forming sell side liquidity just above of the opening range gap, the opening range gap high specifically. So retail traders are going to be trusting this as safe support that we can trade at, setting their stop loss orders or sell stops below these levels here, below this level, and pretty much hoping that price is going to be running up higher. The moment we break above this high, it's even more like they're even believed in this, that this is going to be really safe place to trail my stop loss. All right. So many of them they'll trail their stop loss to New York launch since high liquidity, believing that this is a safe place to keep my stop at. Sooner or later, to your surprise, the moment we took out the buy side liquidity right there, we just kept pushing down lower, 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 lower. We traded into the consequence of that opening range gap, formed the low just near the opening range gap low, a bit of retracement into that fair value gap, and then push down low the opening range gap and into the London session sell side liquidity. Below the sell side liquidity, below London session sell side liquidity, you have the weekly fair value gap right there. So, and also there was a chance to go short at this fair value gap right there if you'd want to add more shorts here. So I know a lot of people are saying, okay, that's all good and true, but where's your executions? Where are your executions? Like, all right, it's good to know about these things, but we want to see some executions. All right, that's what I've been saying since the beginning, because it's a trade breakdown. It is not just an educational video like your guru. It's just like teaching something in hindsight. I'm trying to approach something that is happening Now it's showing as it's in hindsight, but I've traded it live. So it's in a way or another, I'm trying to catch two birds with one stone. All right. I'm trying to teach you things that I'm doing live, but in a manner where it's just in hindsight. But I've been through the situation or the conditions trading it live. So right there is my entry, and right there where I've closed it was a limit order setting just at the opening range gap. Yeah, the consequence to that opening range gap. So these are the execution levels, or what they're called. So, and this is a 15-minute time frame chart just to show you the executions. And it's not something that has been done in hindsight, it's something that have been done in real market conditions. And that's the execution levels. Now, this is just to this pretty much educational video was just teach you how I use the opening range gap to trade these markets, how I utilize them, not them alone, by the way. I do utilize or pretty much include other things in my repertoire other than the opening range gap that allow me to use the opening range gap to my benefit. Obviously, you'd have to know more in order to utilize them and know exactly when price is going to be reaching towards these price levels in the future, and as well as looking at liquidity pools and favorite gaps. You have to pretty much start learning how to trade because BDR rates are also subjective. If you're looking at specific price chart, for example, this 1 minute time frame chart, many people are going to be trading very different things. Some of them will be trading the favorite gap as I've traded. Some of them will be trading the bearish breaker right there. Some of them the bearish order blocks. Some of them the volume imbalance whatsoever. But one thing that is not subjective in terms of entries and exits are liquidity pools and inefficiencies or favorite gaps. So you have to start looking into pretty much trading and how the market books. So the market books primarily on two things. It's just either the favorite gap running to inefficiencies or running towards liquidity pools. The buy side liquidity pools, the highs, old highs, or sell side liquidity pools, old lows, or just a low. And you also want to weigh in the significance of each buy side or sell side liquidity by knowing and pretty much blocking, limiting the time of the liquidity pool. So in this case, we have New York lunch. That's from 12 to about 1 a.m. 1 p.m. Sorry, that's this is the good that's been building here below. So this is New York lunch because it's being related to a very specific element, which is time. You've always look at time. It's time and then price. You don't look at price first. No, you look at time. What time is it? We look at 9:30. What time is it? It's 9:30. For we start looking for entries. We start looking for footprints, some intel that we can use that we can utilize to have a trade. And then when price form, it's pretty much a dynamic thing to use that trading liquidity pools and favorite gaps. So, and also one more thing I want to draw your attention towards is that notice here that my entry, what time is it? Between 10:50 and 11:10, what do we have? We have the macro 10:50 to 11:10. This macro will pretty much have a lot of orders, a lot of functions in this macro between 10:50 and 11:10. So my entry was in this macro, in this time window between 10:50 to 11:10. This is a very important thing for you to pretty much go to your charts and look deeply into. Don't take my words granted, all right? You have to go into your charts. I've tried to lay some ground for you, but From now on, you have to go and whatever I've mentioned in this educational video, you have to go to your charts. Don't take my word for it. Just go to your charts and try to prove me wrong. Try to challenge yourself. It's just like a challenge. Try to prove what I'm trying to mention here, what I'm trying to discuss wrong. And you'll see that you easily can spot these, and how it's like so simple to look at these things and spot them and even trade them. It's just you have to pretty much gather the experience, go over this long period of time. It's not something that you can attain in a 3 day workshop, or a week, or even a month, or sometimes even a year is not enough. You have to constantly look at these markets. You have to be part of these markets. Uh, you have to be a student of these markets, a lifelong student of these markets. And if you don't have it in you, if you don't have the passion to be part of this, it's better for you to not even begin. It's better for you to just not even try to learn it, because it's not something that get rich quick scheme. It's not something that you can just do it for like few weeks, maybe few months, and then just stop. No, it's just like a career. You want to be an expert, you want to be a master of this. So if you want to be a master, you have to spend a lot of time. You have to spend a lot of energy, a lot of time pursuing this. Otherwise, it's just going to be a waste of time. It's going to be an entertainment video. This video, even the educational video that you're watching, is just going to be a waste of time. It's going to be an entertainment to you. So you decide how you're going to be using this information. You decide how you're going to be utilizing it. So I believe that's going to be pretty much it. I know that I do get into some rants between now and then during the video, but it's all to your benefit, because I'm trying to lay you some of my experience. I'm not that experienced as my mentor, but I'm getting my footsteps here and there, just to pretty much get better better than my mentor. My mentor has reached to the levels that he reached by with 30 years of experience, 30 plus years. So I'm trying to attain what he's achieved in terms of experience, and or trading pretty much knowledge in less than what he has spent on. That doesn't mean that when I reach that level, I'm not gonna be trading. No, that means that I have more potential for me to attain better limits. So don't put any limits on yourself. I really hope you found this one insightful. Until I talk to you next time, be safe. Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh.